One letter showed up in Logan's mailbox, and it changed his payment by $400 a month. He didn't get a raise. He didn't move house. His mortgage just came up for renewal, and the interest rate had moved while he wasn't looking. That's the strange power of a number most of us ignore. Interest rates quietly set what your mortgage costs, what your savings earn, and what your debt charges you. Today, we follow one number, from the Bank of Canada all the way down to Logan's kitchen table, and watch what it actually does to his money. Start with what a rate even is. An interest rate is the price of money. When Logan borrows, it's the rent he pays to use someone else's cash. When Logan saves, it's the rent the bank pays him to use his. One number, two sides. The same rate that makes his mortgage more expensive makes his savings account pay more. So a rate going up is never all good or all bad. It rewards savers and lenders. It costs borrowers. Keep that fairness in mind. So who sets the price? The Bank of Canada. They control one key rate, the overnight rate, and in June 2026, it sits at 2.25%. Their job is to keep prices stable, aiming for about 2% inflation. When prices climb too fast, they raise the rate to cool spending down. When the economy stalls, they cut it to get money moving again. They're steering a whole country, not Logan's budget, but that one decision, made in Ottawa, runs straight into his mortgage, his loans, and his savings. Here's how it reaches him. The Bank of Canada doesn't lend to Logan. His bank does. When the bank moves the overnight rate, the banks move their prime rate within days. In 2026, prime sits near 4.45%. Prime is the base price the banks build everything on. Anything called variable is tied to it. His variable mortgage, his line of credit, some of his loans. The moment prime moves, those payments move with it. Fixed-rate borrowing is priced off the bond market instead, so it doesn't jump the same day. Keep that split in mind. It decides who feels a rate change fast and who feels it later. Logan's biggest loan is his mortgage, so this is where rates hit hardest. He has two choices. A fixed rate locks his interest for the whole term, usually 5 years. The payment can't change, whatever the bank does. A variable rate moves with prime. When rates drop, he pays less. When they rise, he pays more. In 2026, a 5-year fixed runs around 4%, and a variable sits a little lower, in the low 3s. Variable is cheaper today, and that price comes with a string attached. Logan carries the risk himself. Let's make 1% real. Say Logan owes $500,000 on a 25-year mortgage. At 4%, his payment is about $2,600 a month. Move the rate just 1%, up to 5%, and the payment climbs to around $2,900. That's nearly $300 more every month, about $3,400 a year for the exact same house. On a number this big, that 1% is a whole car payment. This is why a small move from the Bank of Canada lands so heavy on anyone holding a mortgage. Now the part that caught Logan. He locked his mortgage back in 2021 at about 2% when money was cheap. For 5 years, his payment never moved, but a fixed rate only holds for the term. When it ends, he renews at whatever rates are now. Renewing near 4%, his payment jumps from about $2,100 a month toward $2,500, over $400 more, on the same loan he's been paying down for years. Nothing he did caused it. The rate cycle simply turned. That's renewal shock, and a lot of Canadians are living it right now. A jump like that doesn't stay on paper. It lands on the whole family. $400 a month is the kids' activities, or the vacation fund, or the cushion they were building. So Logan and his wife sit down and adjust. fewer dinners out for a while, a smaller trip this year. Money gets tighter, and they manage. And it runs the other way too. When the Bank of Canada lowers rates, that same payment can shrink, and the breathing room comes back. Their household budget rides the rate cycle, up and down, year after year. Here's the side of rates that finally rewards Logan: his savings. For years, his cash sat in an account, paying almost nothing. When the Bank of Canada raised rates, savers woke up. In 2026, a high-interest savings account can pay him in the low twos, with promotions running over 4%. A one-year GIC pays around 3.5%, where he locks the money in and the rate is guaranteed. His emergency fund earns real money again. The same rate increase that stings his mortgage is a quiet raise on every dollar he's already saved. Savers should enjoy it while it lasts, because this works both ways. High savings rates show up when the bank is fighting inflation. The day they start cutting, those strong GIC and savings rates fade just as fast. A 4% promo quietly becomes 2%. So locking a 1 or 2 year GIC while rates are high can be a smart way to hold a good rate for a while. Cash is a great place to be when rates are up. For money he won't touch for 30 years, it's far too slow. Long money needs somewhere that grows. Now the debt that hurts most: when rates rise. Logan's line of credit is variable, so the day prime goes up, his interest goes up. No letter, no warning. His credit card works differently. It sits around 20 to 23%, almost no matter what the bank does. Carry a balance there, and the rate dwarfs anything his mortgage or his savings will ever do. So when rates climb, the math gets simple. Pay the high-interest debt first. No guaranteed savings rate on earth beats clearing a 23% balance. Rates reach his investments too, starting with bonds. A bond is a loan Logan makes, paying a set interest rate. Here's the part worth understanding. When interest rates rise, the price of bonds he already owns falls. The reason is plain. New bonds now pay more, so his older lower-paying bond is worth less if he sells it. When rates fall, it flips, and his existing bonds gain value. The upside is that fresh money he puts into bonds now earns more than it has in years. Bonds got more interesting the moment rates went up. Stocks feel rates too, in a messier way. When the bank raises rates, borrowing gets more expensive for companies, and safe savings suddenly compete with risky stocks. So markets often wobble or drop when rates climb, and they tend to cheer when rates fall. Logan sees the red days and feels it in his gut. But step back and look at 30 years. The market has climbed through high-rate decades and low-rate ones, through wars, crashes, and recoveries. Rates push the market around week to week. They don't decide where it lands over a lifetime. This is the through line of the whole channel. Rates rise, rates fall, and they'll keep doing it. Logan's entire life. The plan that survives every cycle is the boring one. Spend less than you earn. Buy low-cost index funds every month inside your TFSA and RRSP. Then leave them alone. Logan doesn't try to guess the Bank of Canada's next move. He keeps buying when rates are high and when they're low, and lets 30 years of compounding do the work. Rate cycles come and go. The steady investor just keeps showing up. So let's be fair about who each setting helps. When rates are high, savers and anyone holding cash or GICs do well, and borrowers feel the squeeze. When rates are low, borrowers, home buyers, and people who own stocks and property come out ahead, while savers earn almost nothing. There's no setting that's good for everyone at once. Whether a rate move is great news or hard news depends on which side of the money you're standing on that year. And Logan, like most of us, usually stands on both sides at once. So what does Logan actually do with all this? 4 calm moves. He keeps his emergency fund in a high-interest account or a short GIC, so his cash earns while rates are up. He attacks any variable, high-interest debt first because that's where rising rates bite hardest. On his mortgage, he picks fixed or variable based on what lets him sleep at night, not on guessing the future. And through all of it, he keeps buying index funds every single month. He can't control the Bank of Canada. He can control those 4 things, and that's enough. Here's the part to hold on to. Interest rates will rise and fall for the rest of your life, and you can't control a single move they make. What you can control is the gap between what you earn and what you spend, and where you put that gap. Keep some cash earning, clear the expensive debt, and feed low-cost index funds inside your TFSA and RRSP year after year through every rate cycle. That's the plan that holds. If following Logan's money helped today, hit subscribe so the next Canadian Money Breakdown finds you. Take care of yourself, take care of your people, and put a little money to work today.